Welcome to another installment of the Advisor Series with Dave Harris of Harris & Associates, a registered investment advisor. This series of interviews and conversations is designed to help you find financial fitness by answering the pressing questions on the minds of today's investors.
Hi, welcome to the Advisor Series. We have a special treat today because we are going to have a conversation with Dr. David Kelly, who is Managing Director and Chief Market Strategist for JP Morgan. He's been with JP Morgan since 2008, and he provides valuable insight and perspective on the economy and the markets to thousands of financial advisors and their clients. I met David several years ago at a conference in Dallas, and we struck up a great friendship, and we've been in communication regularly since then. He is a CFA charter holder and a very smart economist. I think you'll appreciate the conversations we have with David. So hi David, and welcome to the Advisor Series. My clients are feeling a little bit better about the economy than they were last year, but they still worry about the direction the economy is taking. So what are the latest figures, and what do you think is happening with the economy today?
Well, the economy is sort of muddling through. The economy is in a recovery, but to my mind is a little bit like an Irish summer, which is a series of consistent disappointments. The economy is growing fast enough to create a few jobs, really not fast enough to bring the unemployment rate down. So I think we are on the road to recovery, but it looks like a very long road from here.
All right, very good. Well, you know, one of the things that they worry about is their houses, their values of their homes, and they're worried about whether those values are going to increase. It's interesting, even though they're living in their homes, maybe their homes are lower equity, but they're making the payments and they're living the same life, but nevertheless it puts a real weight on their psychology.
Yeah, and of course we've had nothing but bad news about housing for a number of years here, but when we look at the numbers, we feel reasonably optimistic about housing, particularly for the long run. Mortgage rates are extraordinarily low. We have not seen mortgage rates this low since Dwight D. Eisenhower was in the White House. And because mortgage rates are so low, because home prices have already come down quite a lot, and more obviously in some parts of the country than others, but because of that, housing is actually very affordable, and that does seem to have stopped home prices from falling nationally. If you look at the average price of existing homes over the last year, that has actually been about flat. It came down about 25% nationally from its peak. It has been flat. We've got a lot of inventory in the market, and that's stopping home prices from appreciating for a while here. But we've got this very affordable market, which I think some people are taking advantage of, and that's stopping prices from falling. So right now we're sort of in a holding pattern, but I believe that over the next few years, the next move is up rather than down for home prices.
Okay, well that's encouraging. Now the second thing, of course, besides their home is their 401k, their investments, their IRA, their capital account. And the stock market has certainly improved since March of '09, but it seems to have gone into kind of a sluggish, soft spot here, and clients are worried. Are we going to get back to where we were? Most of their account values, for my clients at least, are back pretty close to those values, but now they're worried, where is it going to go from here?
Well, I think it really depends upon the economy. There were a lot of fears over the summer that we were going to see a double-dip recession. We don't think that's going to happen. I mean, as I said earlier, we do have these this is a disappointing recovery. It's not that strong. But the key thing about recessions is recessions tend to be concentrated in areas like auto sales and housing and business equipment spending and inventories. Those are the cyclical sectors of the economy. And when you have a recession, those sectors usually go from boom to bust. But if those sectors are already in the basement, it's very hard for them to fall further. And that's really why we think the economy won't see a double-dip recession. And as we get past those worries, as we get into 2011, perhaps with some clarity in the political situation, we think that confidence will improve a bit. Meanwhile, earnings are going up very strongly. Stocks are good value. And I think over time, as people get a little bit more confident in the economy, they'll begin to put more money into the stock market. And that's really what's holding the market back. We simply need more people to be investing in stocks for stock prices to move higher.
Right. So it really takes some confidence, and that is yet to actually materialize. You know, a lot of my clients are worried about employment. I have a few that are unemployed, who've between jobs right now, and almost everyone knows someone or has a family member who is unemployed, and I guess the hard part for them to realize is that employment is really kind of a lagging indicator, sort of the last thing that's going to come back. So what do we see? Are we starting to see some glimmer of employment improvement?
Well, we are seeing some job growth, and we're seeing private sector job growth of running between 25 and 100,000 people per or jobs per month. It's not a lot, it's not enough, but we are seeing some improvement there. But I also think that on an individual basis, it's important to realize how dynamic the job market is. I mean, there's a report the government puts out called the JOLTS report, Job Openings and Labor Turnover, and it's really an eye-opener. Over the last year, we've seen about 50 million new jobs created in the United States. The problem is we've also seen about 49 million people quit or get laid off in the United States. So we've got this enormous churn, and that sometimes nets out a gain, sometimes nets out a loss. But for the individual, what it means is, look, if you're qualified, if you think you can do something, get your resume out there, pound on doors, because the truth is every single day, there are hundreds of thousands of people being hired and fired in the United States. And those who are aggressive, those who are qualified, those who can add value to a business, they can find jobs in this economy. It's just the economy isn't producing enough of those new jobs to keep employment rising at a strong pace. But there are new jobs for qualified individuals.
Well, that's a very encouraging thought, to realize that there really are jobs happening out there. And if you're just looking at the net, it doesn't seem to move that much, but that there are people being hired every day. The last big fear that my clients are concerned about is inflation, and there's a lot of politically motivated comments, I believe, about inflation as if it's happening tomorrow. But you were telling me the other day that we are in a deflationary period right now, in fact, and that with the economy not performing very dynamically, being sluggish, in fact, that it's going to be a while before we start seeing inflationary pressures.
Yeah, I don't think I'd go quite so far as to say we've actually got outright deflation. We still have a little inflation. It's about 1% year over year on the core inflation rate. And we think that's what's going to happen. So long as we avoid a double-dip recession, we're going to just have a period of very low inflation. But I do want to emphasize that deflation is a risk, and the risk of runaway inflation in the upside is very low. What we know is we've still, despite what I just said about the job markets, there are still 15 million people looking for a job in America, and that weight of unemployed people is holding down wages. Businesses don't really have to pay up because people are so happy to have a job. In addition, we've got about 4 million vacant apartments in America that is still holding down rents. We've got about 25% of our industrial capacity lying idle. That is holding down manufacturing prices. So with all this slack in the economy, we really don't think inflation is going to take off over the next few years. In a few years from now, if we're talking and the unemployment rate's down to 5% nationally, we can revisit this. But over the next few years, we do not think that inflation is going to be a problem for investors.
Excellent, excellent. Well, I really appreciate you taking your time, David, and we always appreciate all of the good support we get from JP Morgan. Your guide to the markets I show to my clients, and we talk about some of the specifics from time to time. I wish you well. Have a great week.
Thanks. You too, Dave.
Bye-bye. So there you have it. I hope that was encouraging to you in terms of navigating your own financial challenges. Our goal is to help you maintain financial fitness and to be able to do a better job for your life and your family. At Harris & Associates, we're dedicated to helping our clients and their friends and relatives to meet the financial challenges that they have today. So if you have a question, feel free to give us a call. We're here for you, and we would love to talk to you. Have a great week. I'm Dave Harris. Until next time.